When you hear the word futures, it sounds complex, almost intimidating, like something only Wall Street professionals should touch. But the truth is, the idea behind futures is actually very simple. It all starts with one basic concept: agreeing today on the price of something that will be delivered in the future. That's it. Imagine a farmer growing wheat. He doesn't know what the price of wheat will be 3 months from now when he harvests it. If the price crashes, he loses money. If it skyrockets, he wins. But he doesn't want uncertainty. He wants stability. So he makes a deal with a buyer today. In 3 months, I will sell you my wheat for this price. That agreement is a futures contract. He locks in the price now for something that will happen later. This is how futures started. Simple agreements between producers and buyers. But today, futures have grown into one of the biggest financial markets in the world. Future contracts exist for everything: currencies, stocks, indices, commodities, crypto, gold, oil, you name it. Even though they're used for serious purposes, the concept is very similar to everyday life. Think of buying concert tickets months in advance. You pay a fixed price now, even though the concert hasn't happened yet. If demand increases later, you got a good deal. If demand falls, you overpay. But either way, you locked in a price for a future event. That's the same logic for futures use. In trading, futures contracts allow you to speculate on whether the price of something will go up or down in the future, without even actually owning the physical asset. When you trade gold futures, you don't receive gold bars at your house. When you trade oil futures, no one is delivering oil barrels to your door. These contracts are financial agreements, not physical deliveries. Now, here's where it becomes interesting for traders. Futures gives you leverage, meaning you can control a large contract with a smaller amount of money. This magnifies both your potential profit and your potential risk or loss. For example, with a few $100s, you might control a futures contract worth thousands. Futures move fast, and that speed is exactly why traders love them and why they require discipline. Another key thing to understand is that futures have expiration dates. They don't last forever. The contract has a specific date when it expires. Traders choose whether to exit the contract before that date or roll into the next contract period. Many beginners don't realize this and wonder why future charts suddenly gap or move strangely. It's because contracts are expiring and shifting to the next one. Futures are also traded nearly 24 hours a day, and the volume is massive. This is why futures markets are known for clean price behavior, less manipulation, tighter spreads, and more liquidity. Institutions, hedge funds, and large speculators use futures heavily because they are efficient and transparent. Let's make this even more relatable. Think of a future as a bet: structured, organized, and standardized. If you expect the S&P 500 to go up, you buy an S&P futures contract. If you expect it to drop, you sell a futures contract. When the price moves in your favor, you make money. When it moves against you, you lose money. But because futures use leverage, even small movements can create big outcomes. Another unique part of futures is that they are standardized. Every contract specifies exactly what it represents: the size, the thick value, the expiration date. Nothing is vague. This makes the market organized and predictable. Traders know exactly what they're entering. Speaking of thick value, futures don't move in pips like Forex, they move in ticks. The smallest unit of change in a future contract, and each tick has a dollar value attached to it. For example, in some contracts, one tick might equal $1.25, while in others it could be $12.50 or more. Understanding tick value is crucial because it directly affects your profit and loss. One of the biggest advantages of futures is liquidity. Because so many institutions trade futures, it's easier to get in and out of positions quickly. You get higher spreads and smoother price action. This makes futures popular for day traders and scalpers who actually need efficient execution. Now, let's connect futures to smart money concepts. Future markets follow the same price principles: liquidity pools, fair value gaps, displacement, mitigation, structure shifts, all of it. Because institutions dominate futures, the patterns you see tend to be cleaner and more logical. For example, futures markets often show clear liquidity graphs and more defined displacements because these markets are driven by large order flow. Another powerful use of futures is the hedging. If a large investor holds stocks, they can sell stocks index futures to protect themselves from a market downturn. If price falls, the loss on the stocks is reduced by the gain on the futures. This makes futures a tool not just for profit but also for protection. Let's bring everything together with a simple story. Imagine you run a coffee business and you're worried coffee beans prices will rise. You buy coffee futures now at a fixed price. Months later, the real price has gone up, but you're protected because your futures contracts locked in the cheaper price. On the other hand, a speculator might have bought the same futures contract simply because they expected the market to rise. Both of you benefit, but for entirely different reasons. So to summarize, futures are contracts that let you speculate or hedge based on the future price of an asset. You are leveraged, they are standardized, and they're fast. And they operate in some of the most liquid markets in the world. Whether you're trading indices, currencies, commodities, or crypto, futures give you a window into institutional behavior and high-volume price action. At first, futures might seem technical, but once you understand that they are simply agreements about the future price of something, everything becomes much more clear. They are a powerful tool, but like all powerful tools, they require knowledge, practice, and a lot of discipline.